sleep, and hustle on every day. And that's on every day. Never broke again. Great challenge. Really making out so that she's special. Sometimes she feels secure because I'm gonna fucking protect the way. Don't boy measure, I can't help you comprehend on these. Let's get this club, all to the flood, it's better kill. It is better on his way, I promise not to let them live. I'm gonna figure no Apollo, bitch, keeping on my rear. I'm in this bitch, one is gonna be keeping when you leave here. All you want, she gon' sit back and probably burn on my gun. Her friend ain't hit me with my music, and take it out on her. Bitch, stop the bed, but I've been heaven in the cabin with the stars. I got these dancers and a dance, and I'm leaning out there. It out, and my score, yeah, why she take it hard? My cats out the whole tour, niggas know about top dude. Collect the millions, no keeping, they listen when I'm so I get a bitch in me and then she turn it on my influence. Watch as I speak it, it be so fluent. I don't wanna help them out on something, because I bet not going. Still investing in collecting, you know how I'm doing. Don't do the They can get critical. No, I rephrase it. I say they can get lyrical. When it comes to this game, and shit in real life situations, I'ma spit it in a whole different form. They gon' make it critical. You pussy niggas, you know what I ain't about no niggas. That my little polar is kicking in. No. This one for all the hustlers. Ain't nobody gonna outwork me. Ain't nobody gonna outwork the Sean. This is the mixtape. Let's hustle. Mic test. Let's see what price does at the open, and we look to either buy or sell.
Mastering your trading psychology and transforming the way you approach the markets. Before we dive in, don't forget to like, share, and subscribe so you never miss power from confusion to clarity, from hesitation to confidence, and from inconsistency to discipline. It is not about promising success with a secret formula. It is about building a solid mental foundation, one that can withstand the pressures of the market and support growth over time. With this new understanding, traders can begin to move beyond struggle and step into a new way of thinking, one that leads to control, confidence, and results. Chapter 2: Why a New Thinking Methodology. In the world of trading, most people come in with a way of thinking shaped by traditional environments like school, work, and everyday decision making. These environments are structured, filled with rules, schedules, expectations, and a clear sense of cause and effect. When someone performs well, they get rewarded. When they make a mistake, there's usually a way to fix it or a system in place to guide them. But trading is not like that. It operates in a completely different kind of environment, one that is uncertain, unstructured, and without guarantees. This is why traders need to develop a new kind of thinking. The kind of thinking that works in the outside world doesn't necessarily help when decisions are made in a space driven by probabilities, not certainties. Most traders bring their old habits into the market. They rely on logic, reasoning, and control, expecting those tools to give them consistent results. But in trading, the market doesn't respond to personal logic. It doesn't reward effort just because someone worked hard. A trader can spend months studying charts, analyzing patterns, and learning strategies, yet still face losses. This disconnect happens because the market is neutral. It doesn't care about effort or fairness. It moves based on a constant flow of buy and sell orders, emotions, opinions, and decisions made by thousands of participants. Because of this, traders must rewire their minds to operate in an environment where anything can happen at any time. They must learn to accept that no matter how good a trade setup looks, there's always a chance it won't work. This doesn't mean the strategy is broken or that they did something wrong. It simply means the market didn't move in the expected direction at that moment. That's why the ability to think in terms of probabilities becomes essential. To succeed, traders need to shift from a mindset of being right to one of managing risk. The goal is not to be correct every time, but to manage trades in a way that wins are bigger than losses over time. This approach requires mental flexibility. Traders must become comfortable taking losses without emotional distress, because losses are simply part of the process. They are not signs of failure, but part of the mathematical outcome of working with probabilities. Traditional thinking also encourages traders to seek certainty and control. But in trading, these things don't exist. There is no way to predict with 100% accuracy what will happen next. No system can remove all risk. Trying to force control often leads to hesitation, fear, or overtrading. Instead, traders must learn to flow with the market, to make decisions based on edge and probability, and to take responsibility for every outcome without blame or excuses. Another part of this shift in thinking involves letting go of the need for external validation. In structured environments, people often look to others, teachers, bosses, or peers for feedback and reassurance. In the market, there is no one to ask. Each decision must be made independently. Every trade requires trust in oneself, not in others. This means traders need to build confidence not for being right all the time, but from knowing they can handle any outcome. There's also a tendency among new traders to look for the perfect system or the secret formula. This search can go on for years and often leads nowhere. The truth is that no system guarantees success without the right mindset. Even the best strategy will fail if it's used with fear, hesitation, or impulsiveness. So the focus must shift from searching for certainty to building the ability to follow a method consistently, regardless of emotional ups and downs. Over time, traders who adopt this new way of thinking begin to separate themselves from the outcome of each trade. They learn to see the market as a game of probabilities. They don't need to win every trade because they understand that their edge will play out over a series of trades. They don't panic when a trade goes against them because they've already accepted that outcome as possible before entering. This mindset frees them from fear and opens the door to consistent performance.
If we have
This new
price
thinking
maintaining the
methodology is not easy and it doesn't happen overnight. It requires awareness,
distance to
repetition,
run to London,
and patience. But once developed, it becomes the foundation
with
for long
flipping
term success.
seven,
It turns trading from a stressful experience into a process of execution and self discipline. The real work lies not in predicting the market, but in managing oneself. And that begins with thinking differently than before. Chapter 3: The market is always right. The market is a living, ever changing environment made up of countless decisions from traders and investors around the world. Every movement on the chart, every uptick and downtick, is a reflection of their beliefs, expectations, fears, and confidence about the future. The market is not trying to hurt anyone or reward anyone. It is simply the total outcome of all participants acting on their own interpretations of information. What many traders do not realize is that they often see the market as something they can control, something that should behave according to their analysis or opinion. But the market doesn't respond to individual logic. It doesn't care about anyone's personal views, strategies, or predictions. When a trader buys or sells, they're interacting with something far bigger than themselves, a constantly flowing stream of decisions from millions of minds. Believing the market is wrong because it went against a trade or analysis is one of the fastest ways to lose. The idea that it should have done something different reveals an attachment to a personal point of view. The truth is, the market is never wrong. It simply is. Prices reflect the current truth of supply and demand. If price rises, more buyers are active than sellers. If it falls, sellers are in control. That's all there is to it. When traders operate from the belief that the market is right, they no longer argue with what's happening on the screen. Instead of hoping the market returns to match their
we can get
position, they adapt. They observe what the market is telling them
or
and accept that
9:15 or
message instantly. This shift
get a
moves from
close it
being
when we reach
emotional to being
2% of the
fluid. It becomes a process of responding to reality instead of resisting it. Expecting the market to behave in a certain way based on a prediction leads to emotional attachment. When the outcome doesn't match the expectation, frustration and confusion arise. But when traders accept that they don't know what will happen next, and they trust that the market will always tell the truth, they stay in alignment with reality. This alignment is what gives them the edge. There is no room for pride, ego, or emotional struggle in trading. A trader might spend hours analyzing a setup and feel certain about the outcome. But if the market moves in the opposite direction, the analysis becomes irrelevant. The market is not obligated to fulfill anyone's forecast. What matters is the ability to let go of the need to be right and stay focused on what the market is doing now. Reacting to the market with an open mind rather than a fixed belief allows traders to stay flexible. If they're wrong, they can exit quickly without resistance. If they're right, they can stay in the trade with clarity and confidence. This mental flexibility is a major strength. It removes the emotional weight of being right or wrong and replaces it with the clarity of managing risk and responding to opportunity. Each trade has a life of its own. It is not connected to
price
the
wants to
last
go.
trade, nor does it determine what will happen in the next one. When traders accept that the market is always right, they stop trying to impose a pattern or story where none exists. They deal with each situation independently and stop projecting their emotions onto price action. Understanding this allows
There's
traders
an
to
hourly
move
fair
forward
value gap here
instead
as
of
well
saying the market betrayed them or that it
that we
doesn't make
traded into.
sense. they realize their expectations were out of sync.
Um,
This acceptance is powerful.
let's go.
It turns losses into lessons and keeps the mind focused and calm. There is no fight to win against the market. There is only the task of aligning with it and managing trades with clear rules and awareness. Trading becomes less stressful when the responsibility shifts inward. If the market moves against a trade, it's not a personal failure. It simply means the market revealed a different truth. Traders can use that new information to make
Okay,
quick decisions, to adjust their strategy, or to exit without hesitation. There's no punishment from the market, only feedback. The key is in the mindset. Traders must learn to stop interpreting the market as right or wrong in emotional terms. Instead, they must see it as neutral, fluid, and always correct in its message. Whether price moves up or down, whether it matches a prediction or not, the market is only showing what the collective decisions of all participants are at that exact moment. When this perspective is embraced fully, trading becomes a practice of listening, not controlling. It becomes about managing risk, not proving anything. And most importantly, it becomes about making peace with the unknown and working in harmony with a force that is always moving,
let's
always
see if we can
shifting,
get the
and
hype.
never wrong.
I really want
Chapter 4. There is
the
unlimited
chances
potential for
that
profit and
to be
loss.
honest.
In trading, the potential for both profit and loss has no fixed boundaries. Unlike most professions where the income is limited by salary, time, or structure, the financial markets offer an environment where gains can grow infinitely and losses can spiral out of control just as quickly. This creates a very different kind of experience for anyone entering the market. It opens up a space where people can imagine making huge amounts of money with a single trade. At the same time, it also exposes them to the risk of losing everything
So
just
we're
as
about to run
fast.
out the pre-New
This
York
reality
guys now.
creates a level of freedom that most people are not
I
used
would
to,
like price to
and there are no limits on what is possible. The mind starts to
we shouldn't be
respond
going below the
differently.
midpoint.
The structure of everyday life usually involves rules,
So
boundaries, and clear feedback. You do something, and you get a result. But in trading, those clear limits don't exist. This lack of structure often makes people feel overwhelmed or uncertain. The market doesn't care what you expect or want. It moves on its own terms. And within this space, the trader has to make decisions without any guarantees. Because the potential
we
for
can do
profit
now
and
is
loss
manage
is
our risk.
unlimited, people are naturally drawn to the
Um,
market with hopes of making a fortune. They bring with them dreams of freedom, wealth, and control. But at the same time, they may not understand how this environment works. The same opportunity that allows for massive profit also allows for massive failure. Without clear understanding or preparation, many traders find themselves reacting emotionally to every price movement, making decisions based on fear or greed rather than sound thinking. The human mind
we
has been
still have
shaped
3 minutes
work
to the
within
candle.
environments where actions produce
So I don't want
predictable
to
outcomes. When
quickly
something
move my stop
happens,
to the
many learn
midpoint,
from
but
it. When something
once
doesn't
this
work,
candle closes,
you
we
change
don't
your
want
plan.
price to come back
But in trading, this
midpoint
kind of feedback
of
is
the
never
first 5 minute
guaranteed.
candle.
A bad trade can still make money. A good trade can still lose money. There's no certainty. As a result, many traders begin to behave inconsistently. They may win a trade and feel confident,
Right now, I'm
but
only
when losing
risking my
happens,
initial
they
risk
doubt themselves
the same
completely.
as I would have
They
with the
chase wins or
one
avoid
contract.
losses,
So
forgetting that each
I'm in a
trade
good
is just
position
a
for the
small
morning.
part of a much bigger
If this
picture.
hits stop loss, I
To
can still
function
enter again.
properly in this kind of environment, traders need to think differently. They must understand that the
But at that
possibility of
point, I'll probably be
unlimited
looking
profit
for
or
sales
loss changes everything. It demands a mindset
that
that is built on
in the
risk
market.
control and emotional detachment. If you cannot manage risk, the
Right?
potential for unlimited loss will destroy you. If you focus only on profit without structure, then the very thing you chase will become your downfall. A major lesson is that traders must always protect themselves. The market will always offer chances to make money, but it will never protect you from your own decisions. That job is yours. You must create the structure the market does not provide. This means setting clear limits on how much you risk on each trade. It means understanding that not every opportunity needs to be taken. And most importantly, it means treating each trade as one part of a long term process. In this process, discipline becomes
Okay,
more
what's going on?
important than
This my
desire.
stop loss.
You might want to make a lot of money fast, but without discipline, your desire will only lead to inconsistency. Traders who think in terms of the big picture, who understand the
What just
unlimited
happened?
nature of both profit and loss, begin to act more responsibly. They know that the market will continue to exist tomorrow and next week and next year. So they focus on survival first and growth second. Another key idea is that the
That was
market
weird.
doesn't owe you anything. Just because you want to win or because you've done
Let's see what price
research
was.
doesn't mean you'll be rewarded. You're not entitled to profit. You must earn it by managing your behavior. This means having a plan, following it, and accepting that losses are part of the game. The goal is not to avoid losses altogether, but to make sure that your losses never grow beyond what you can handle. This awareness creates a powerful shift in behavior. When you truly accept that anything can happen in the market and that profit and loss are both unlimited, you start to focus less on being right and more on being consistent. You understand that your role is not to predict perfectly, but to respond wisely. You realize that your edge lies not in your analysis alone, but in your ability to manage yourself under pressure. In the end, the freedom offered by the market is both a gift and a trap. It gives you the chance to build something great, but only if you approach it with respect, structure, and self control. If not, that same freedom
That's
can
weird.
tear you
Who
apart.
would have been
The
already
choice is
predicted?
yours.
That's crazy.
Chapter 5. Prices are in perpetual motion with no defined
So
beginning or
some
end.
targets
In the world of trading,
thing
prices never stay
looking for
still.
price to
They're
expand.
always in motion, tick by tick, second by second, shaped by endless streams of information and
Um,
collective actions of traders around the world.
this
There is
4
no
hour
official start or
regular now,
end
you can
to
see
this
that
movement. Prices do not begin at
4
one
hour
point
candles form
and neatly finish at another. Instead,
would be
they continue,
interested in
flowing constantly without pause, forming a never-ending river of market behavior.
of this has
This constant motion can confuse many traders who expect structure. They look for clear starting points or try to define specific moments when something begins or ends. But the reality is that prices reflect an ongoing process of belief, reaction, and adjustment. Every price change is a reflection of what traders believe about the future right now. And because beliefs change, the market changes. Nothing stays fixed and nothing ever finishes. It just keeps going. This type of environment can be difficult to adjust to, especially for those trained in fixed systems or structured thinking. In school or at work, there are clear beginnings and endings. Lessons start and stop. Workdays begin and finish. But in the markets, there is no such order. The price you see is simply the current result of all past and present activity. It's like trying to capture wind in your hands. You may see where it was, but you can never freeze it. Most traders, especially those new to the market, try to give structure to this motion.
looking like
They
a
look for
consolidation
patterns,
thing, and I'm
starting
not really
points,
fucking
or
with
signs that tell them what will happen next. While patterns can exist and repeat at times, they're not guarantees. What causes price to move in a certain direction today might not do the same tomorrow. And trying to hold on to a
it.
pattern or predict an outcome can often lead to false
Probably get
confidence
one
and
more trade
hesitation.
today, and
The
that's
key is to stop trying to find a beginning or an ending in price movement. Instead, learn to accept that prices are in constant change. Every moment in the market is new. Even if it looks like something that happened yesterday, it's not the same. The people in the market are not the same. The news is not the same, and the collective reaction will always be unique. When a trader understands that the market is fluid and always in motion, they start to see opportunities differently. Instead of looking for a perfect point to enter or exit, they begin to focus on flow. Trading becomes less about being right and more about adjusting to what is happening now. If a price is moving in a direction, it's not important why. It only matters how you respond to it. Being flexible in your thinking allows you to move with the market. Trying to stop the flow or trying to force it to fit your plan leads to mistakes. If you expect prices to behave in a way that suits your needs, you're setting yourself up for disappointment. But if you understand that prices are part of an ongoing movement, you can position yourself to ride that movement without resistance. Another important part of this lesson is accepting that price action is not a story with a beginning, middle, and end. It's simply action. If you try to create a story out of it, thinking, for example, the price must go up now because it dropped earlier, you are inserting your own expectations into something that doesn't follow a script. The market doesn't know you. It doesn't care what you want.
it's gonna be
It
my
doesn't know
last
your
trade
pattern.
for the day.
In this type of environment, what matters is your ability to observe without judgment, to act without fear, and to adapt without resistance. When you stop searching for defined turning points and start responding to price as it flows, you begin to trade in alignment with the market's nature. You no longer fight what's happening. You simply join it when it makes sense and step aside when it doesn't. Price movement is not personal. It doesn't have a personality. It is simply the product of buying and selling. And since buying and selling never stop, price never truly stops either. The trader who thrives is the one who stops looking for the start or the finish line and instead focuses on where the market is now and how to be a part of it without trying to control it. Let go of the need for structure, let go of the illusion of control, and step into the flow of the market with awareness and readiness. In a world where price is always in motion, success belongs to those who move with it, not those who try to stop it. Chapter 6. The market is an unstructured environment. The trading environment
That's
stands
so
apart
crazy
from
to me.
most other environments in life. It
Like,
doesn't follow
that's
a
what I get.
predictable structure. There are no rules,
That's my
no
fault.
boundaries, and no fixed patterns that can be relied upon consistently.
I need to work
Unlike
with when to
school
go
or a
break even
workplace where
on
expectations are clearly
my stuff
defined and
that's
success follows a
like,
logical path, the market provides no such framework. It's a space where anything can happen at any time and no one is in control of the outcome. In this space, traders are responsible for creating their own structure internally. In normal life, people are trained to follow directions, adhere to rules, and respond to authority. From a young age, everything is structured: classrooms, jobs, schedules. Performance is judged by external benchmarks. When someone follows the rules, they are rewarded. If they break them, there are consequences. This system teaches people to rely on external guidance to determine right or wrong and to shape their behavior accordingly. The market doesn't offer this kind of feedback. There's no teacher, manager, or authority figure telling a trader whether they're doing it right. Success in the market cannot be earned by obedience, nor can it be predicted by following a fixed formula. A trader may make a perfectly logical and well researched decision and still lose money. Someone else might place a random trade with no reasoning and make a profit. The outcome doesn't always reflect the quality of the decision. This absence of structure can be confusing and disorienting for those who are used to being told what to do. To succeed in this environment, it's essential to create personal rules and internal structure. This includes developing a trading plan, setting risk parameters, and following a consistent method. These rules aren't imposed by any external system. They must come from within. Discipline comes from the trader's ability to follow their own rules even when the market offers no pressure to do so. There's no penalty for breaking
they
rules
really had
unless
to
it
stop
results in
me out
loss. And sometimes even bad behavior is rewarded with
twice
profits,
before.
which reinforces the wrong habits.
That's all right.
Because the market is unstructured,
This one
it
trade we could
allows
recover
each
our loss.
trader to experience it in their own way. Two traders can look at the same chart and see two entirely different opportunities or threats. There's no right or wrong answer. What matters is how each person interprets the information and acts on it. This means that personal beliefs, emotions, and experiences shape the perception of the market. Traders do not respond to the market itself, they respond to their interpretation of it. In an unstructured environment, it's easy to fall into emotional reactions. Without a set of rules to follow, traders may act impulsively, chase profits, or avoid taking
Just gonna let
risks.
this play
They
out
may change
for a bit.
strategies
Now,
frequently or allow
oh,
fear
for
or
our damn
greed
here, like
to control their decisions.
I'm not gonna
This is where structure becomes vital. A trader needs to
trade that to
impose their own set of consistent actions
like some
regardless of what
problem.
the market is doing. Consistency
I
can
really have
only
one
come from
contract, so
within,
it's nothing
not
I
from
can do really.
external conditions. The freedom of the market is both a gift and a challenge. It offers endless opportunities, but it also demands responsibility. There are no guarantees. No one can predict what will happen next. A trader must learn to be comfortable with uncertainty and act in a way that reduces risk while allowing for potential reward. They must accept full responsibility for their actions without blaming the market or external factors. The lack of structure also means that traditional learning doesn't apply. In most environments, people learn by trial and error. If something doesn't work, they adjust and try again, and eventually a clear pattern of success emerges. In trading, this approach can be misleading. What works once may not work again. Success can reinforce bad habits, and failure can come from good decisions. The cause and effect relationship is broken. Because of this, traders must focus on the process, not just the outcome. They need to follow a plan consistently, manage risk properly, and avoid making decisions based solely on recent results. The process must be based on probabilities and repeatable actions, not on gut feelings or chasing market moves. Only then can a trader begin to create a stable foundation within an unstable environment. To succeed in the market, a trader must learn to manage themselves. They must replace the structure that's missing from the market with rules and routines that guide their behavior. They need to build confidence, not by trying to control the market, but by learning to control their own actions. This self created structure becomes the anchor in an environment that otherwise offers no safety or certainty. In the end, the market rewards those who can remain steady amid chaos, follow their own system despite distractions, and take full ownership of every decision. Chapter 7. In the market environment, reasons are irrelevant. In a market environment, explanations and reasons are irrelevant. Trying to understand why the market moves in a certain way is not only unnecessary, but often dangerous to a trader's performance. The market is not a structured environment where logic, cause and effect, or traditional analysis guarantees understanding or control. It is a flowing, ever changing reflection of the collective actions of millions of participants, each with different beliefs, motivations, expectations, and levels of understanding. When someone attempts to apply logical reasoning to explain market movement, they fall into the trap of false security. For example, a trader may hear news or observe certain technical indicators and believe they know what the market will do next. But this belief is just an assumption. The outcome may or may not align with the assumption, and if it doesn't, the trader may feel confused or betrayed, leading to emotional decisions. The real problem arises when the trader begins to believe that understanding the reason behind a market movement is a requirement before taking action. This belief slows down decision making and damages consistency. The truth is, traders don't need to understand why
Gonna
the
play it one
market
more time.
moves in a particular direction in order to make money. The market is not something that can be logically understood at all times. It behaves based on probabilities, not certainties. Each moment in the market is unique, and every price movement is the result of a unique combination of variables, most of which are unknowable. Expecting to consistently understand all these variables is unrealistic. Most traders try to bring structure into their trading by attaching reasons to price action. For instance, if the market goes down after bad economic news, the trader says it was because of news. But if the market goes up after similar news another time, the same trader becomes confused. This confusion comes from trying to apply logic where none is needed. The price moved because more people decided to buy or sell, not necessarily because of a reason the trader can recognize. Believing that understanding the reason behind market movement is necessary creates hesitation. When a trader waits for everything to make sense before acting, they miss opportunities or act too late. Markets don't wait for logic or certainty. They move regardless of anyone's understanding. The key to trading well is to observe the market, develop a reliable method, and then act consistently on that method without needing to explain every movement. Relying on reasons can also lead to personal bias. A trader might decide that the market should go up because of certain news, and when it doesn't, they hold on to their position, expecting the market to eventually agree. In doing so, the trader forgets that the market doesn't respond to personal opinions. It reflects collective action. If the majority is selling, it doesn't matter what news exists or how it's interpreted. It's also important to recognize that news or data is filtered through individual interpretation. 10 traders might hear the same news and interpret it 10 different ways. Some might buy, others might sell, and others might stay out altogether. The market's movement is the result of all these actions combined. So it is not possible to predict or understand a move simply by identifying a single reason. Trading successfully requires learning how to accept the market
You have
as it is,
1 minute
without needing to explain it.
if
This acceptance brings
if
clarity
you turn
and
into an entire
freedom
video
from the
then I'll
burden
put
of
it.
explanation. It also allows traders to operate within a defined risk and reward system
Ridiculous.
rather than depending on understanding why something is happening. This leads to greater consistency. The goal is not to understand every price move, but to become confident in the ability to act without needing to explain. A trader's job is not to be right about the reasons behind a move, but to be right in terms of following a method that works over time. Success comes from following a process with discipline, not from being intellectually correct. Trying to attach reasons to market behavior creates an emotional attachment to the outcome. When trades are based on logic or expectations rather than a tested method, losses feel more personal and confidence gets shaken. But when trades are based on a neutral, objective method, outcomes are accepted as part of the game. Understanding this concept helps traders move away from needing certainty. It builds the mindset required to trade in a constantly changing environment. Detaching from a need for reasons leads to faster decision making, less hesitation, and more focus on executing a plan. Over time, this approach leads to more consistent results and a stronger foundation for long term trading success. Chapter 8: The Three Stages to Becoming a Successful Trader. To become a consistently successful trader, a person must go through a clear process of psychological development. This journey happens in three main stages, each building on the last. At the beginning, most traders think that success in trading is only about learning a good system or strategy.
Yeah.
But real success comes from learning how to manage one's own behavior, decisions, and mental reactions to the market. The path to mastering this begins with the first stage, called the mechanical stage. In the mechanical stage, the goal is to build discipline and trust. A trader must follow a well defined set of rules without letting emotions interfere. This stage requires the
Yeah.
trader to
It's
stay
a down day
calm
today, man.
consistently, regardless of whether a trade is winning or
It's just a
losing.
down day.
There is no room for personal opinion or second guessing.
Me, probably
The
the
focus is
market
only
too.
on following the
Probably gonna crash
rules
from here.
exactly as they are written. This helps to develop the habit of being disciplined. It also teaches the trader how to act in a calm
That's
and
right though.
organized way. When a trader sees that following the
It's bad if
rules
we
leads
get
to
this out the
stable
way
results
now.
over time, it builds confidence in the method. This stage is like laying the
Start
foundation
content
for
tomorrow.
years.
So,
Without it,
so
everything else falls apart. A trader in this stage is learning how to trust the process, even when the outcome of each trade is uncertain. Once discipline and consistency are developed, the trader moves into the second stage, known as the subjective stage. Here, the trader starts to use personal judgment and interpretation. This may include taking into account patterns that are not in the rulebook, using market feel, or adjusting trade size based on experience. But this stage is risky because the trader now feels more in control. They may start to overestimate their ability to predict what the market will do. If the trader hasn't fully mastered discipline in the first stage, this stage can cause confusion and losses. Many traders at this point become inconsistent. They start breaking rules, acting on impulse, or trying to force trades. The danger in this stage is that the trader believes they know more than they actually do. This often leads to emotional reactions, especially when trades go wrong. A trader must be very aware of their own behavior and decisions during this stage. Without that awareness, they're likely to fall into patterns of frustration, fear, or revenge trading. The goal in this stage is to learn how to apply flexibility without losing control. It's about finding the balance between
market is
logic and
ridiculous,
instinct
guys. Don't
while
even
still
worry.
maintaining discipline. The final stage
Tomorrow.
is the intuitive stage. This is where
Yeah.
real mastery
This is
begins.
just great
In
stuff.
this stage, the
It's
trader no
gonna
longer
crash.
needs to think through each decision slowly or carefully.
But
Their
I'm down.
understanding of the market has become so deep
I think I'm
and their
down like
self control so well developed that they can trade naturally
down
without
500.
fear.
That's my
The
max.
trader sees the market
Hey,
clearly
it's
and can
down by
respond
this.
quickly
I'm not even do
without second guessing. There is no fear or hesitation
it.
because they have already learned how to accept uncertainty and
Okay.
risk.
I think
They no
that's
longer
it
need the
now.
emotional comfort of being right.
I'll
Instead,
get my
they're
mind
focused only on the
sorted.
quality of their process. Their confidence is based on experience, not ego. They trust themselves to act in their best interest, even when it means taking a loss. The trader in this stage does not trade for excitement or approval. They trade because they have found peace with the process. They know how to wait for the right moment and how to walk away when there is no edge. Success comes as a result of doing the right things, not chasing profits. Moving through these three stages requires patience and honesty. Many traders try to skip stages or jump ahead before they are ready. But each stage has its own lessons, and those lessons must be learned before real progress can be made. A trader must learn discipline before they can learn how to be flexible. They must learn self awareness before they can trust their instincts. The process cannot be rushed. Each stage prepares the mind for the next one. And only after going through all three stages can a trader become truly successful, not just once or twice, but consistently over time.
Look to
The
take
key is to recognize where you are right now We must stay committed to learning what each stage is meant to teach.
London
The
laws.
journey may be long, but
Actually,
it is also clear.
London laws.
Every step forward is a step toward mastery. Every lesson learned brings more control, more clarity, and more confidence. And in the end, trading becomes not just a skill, but a state of mind. Chapter 9: Understanding the Nature of the Mental Environment. The mind is not a blank canvas. It is a complex environment shaped by everything a person has ever experienced, thought, or believed. To become successful in the trading world, one must understand how this internal environment works, because it influences every decision made in front of a chart or screen. The mental environment consists of beliefs, memories, emotional responses, and psychological filters. These components work together to interpret the external world. What a trader sees in the market is never objective. It is always filtered through personal mental programming. When someone looks at a price chart, what they are seeing is not pure data. It is a reflection shaped by their internal beliefs and expectations. The mind automatically gives meaning to that data, often without conscious awareness. Two traders can look at the exact same price movement and come to completely different conclusions. This is not because the data is different, but because their mental environments are not the same. The information is filtered, processed, and interpreted based on prior learning, emotional associations, and habitual patterns of thinking. Every person has a unique collection of mental
Am I allowed
associations
to express
built from
myself?
past experiences and the emotional
This is how I feel
significance
about the
attached to
market
them.
right now.
When a trader sees a particular
They
pattern, the
trade.
mind might instantly recall a past trade, good or bad, and produce an automatic reaction. This reaction may result in hesitation, fear, or overconfidence, depending on what memory is being triggered. The mind works fast. Before one can even think logically, the emotional memory can already influence behavior. This is why understanding and reorganizing the mental environment is key to consistent performance. The mind stores information in clusters. These clusters form belief systems. For example, if someone repeatedly experiences loss when trading breakouts, their mind may form a belief that breakouts are unreliable. That belief becomes part of the mental environment. Now, when the trader sees a breakout setup, they may unconsciously distrust it, even if it aligns perfectly with their system. The result is hesitation, second guessing, or skipping the trade entirely. These responses are not based on current market data. They're based on mental conditioning. Most traders believe they are acting logically, but in reality, they are responding to past emotional experiences. This conditioning is powerful and often invisible. To gain control, one must first become aware of these unconscious responses. Awareness begins by observing thoughts and reactions without judgment. When a trader starts to notice how their beliefs and emotions are influencing their behavior, they can begin to separate their identity from the market's movement. This step is essential to developing the ability to act objectively. The mental environment also determines how new information is received. If the mind is programmed to protect against loss, it will resist taking risks, even when the odds are favorable. It may exaggerate the danger of small drawdown or misinterpret a signal as too risky. The goal, then, is to develop a mental environment that does not distort reality through fear or greed. A healthy mental environment accepts risk as part of the process and does not let previous experiences cloud the current opportunity. To do this, one must begin to reshape the internal responses. This means replacing
Today's
negative,
gonna be a very bad week.
emotionally charged
We have
associations with new mental patterns that are supportive and
Wednesday,
neutral. This does not happen by accident. It requires deliberate practice.
Thursday, we have
For
something
example,
else. Friday, we
before a
have
trade is placed, the trader can observe their mental
speech
and
or
emotional
something.
state without acting on it. Over time, this observation weakens the automatic power of old responses and creates space for new beliefs to take root. Understanding the nature of the mental environment is not just about knowledge. It is about building self-awareness and choosing to respond differently. It is a process of identifying the patterns that no longer serve a purpose and consciously installing new ones that support consistency and clarity. Traders who do not understand this process often remain stuck, repeating the same mistakes even when they know better. They feel trapped because their internal environment has more control over their behavior than they realize. The real work of trading is internal. The market only provides information, movement, and opportunity. It does not reward intelligence, but discipline. It does not care about opinions, only actions. By understanding the inner mental environment, a trader gains the ability to see the market clearly, to act without interference, and to remain calm when others are reacting. This is not achieved overnight. It is a Chapter 10: How Memories, Associations, and Beliefs Manage Environmental Information. In the trading environment, every decision a person makes is filtered through a unique internal system built from past experiences. This system includes memories, associations, and beliefs. These elements act as mental filters that manage the way external information is received, interpreted, and responded to. People do not respond to the market based on what it actually is. They respond based on what they believe it to be. Every trader brings to the market a set of mental programs that automatically shape their understanding of prices, patterns, and events. When a trader looks at a chart or observes a price movement, the brain immediately searches for stored experiences that resemble what is currently being
Yeah, we can
seen.
anticipate
This
this
match, a belief
different
or a
after
memory, is
it's in
activated,
the
and this becomes the foundation for
first 30
interpreting what
minute
is
load.
happening. This process is almost
Um,
entirely unconscious. It happens instantly, without the trader being
do
aware of it.
we flip
The
bullish?
mind
I
doesn't
mean, we
need to
have 3
analyze
equal
every new
eyes.
situation from scratch.
Ridiculous.
Instead, it relies on what is already known or assumed to be true. This is why
Great
two traders can
as
look at
the
the
London
same
high
chart
now.
and come to completely
So the
different
price closes
conclusions.
above the
Each one
midpoint.
is seeing the
Um,
market not as it is, but as it matches their internal representations of past experiences. Every new piece of information from the environment either fits into existing beliefs or challenges them. If it fits, it reinforces the belief. If it challenges a belief, the mind may distort or block the information to protect the belief. This mechanism is the reason why traders often ignore signals that contradict their analysis. It's not that they choose to ignore them consciously. Their mental filters simply never allow those signals to register as valid in the first place.
yeah,
These
you
filters are designed to create consistency with what is already believed. Beliefs form through repeated experiences, often during moments of emotional intensity. Once formed, they're stored in a way that makes them feel like truth, even if they are based on limited or flawed experiences. For instance, if a trader loses money repeatedly after acting on a breakout signal, they may form the belief that breakouts are unreliable. That belief becomes the lens through which all future breakout opportunities are seen. Even if the conditions are ideal for a breakout trade, the trader might avoid it, not because the market is wrong, but because their belief has overridden the current reality. Associations work in a similar way. If a certain color on a chart, a particular indicator, or a specific time of day becomes linked with a strong outcome, either positive or negative, the brain will trigger an emotional and behavioral response whenever that association is activated again. The trader may not understand why they feel uneasy or confident during certain situations. It's the brain responding to an association that was wired into memory through repetition or impact. The challenge is that these mental filters are invisible to the person using them. Most traders operate under the illusion that what they perceive is an objective reality. But in reality, their perception is being shaped by a history of experiences, some of which may have no relevance to the present moment. This is especially dangerous in trading because the market is constantly changing and relying on outdated or emotionally charged
let's
beliefs
see if
to
you get
guide their
retest
decisions. To navigate this
for
complexity, traders need to become aware of their internal environment. They must recognize that the information coming from the market is neutral.
using
It has
regular
no
trading
inherent
hours.
meaning until it is
See
interpreted.
how we've
The quality of that interpretation
gonna
depends
do this.
entirely on the clarity and flexibility of the beliefs through which it is filtered. Traders must observe how they react to market information and begin to question whether their reactions are based on accurate assessments or on past fears and assumptions. The goal is to develop beliefs that are supportive, adaptive, and aligned with the realities of the market. This involves identifying limiting beliefs, challenging their validity, and gradually
These are
replacing
the
them with
1 minute
those that
island
allow for objectivity and
market
openness.
structure shifted.
It's not about eliminating all emotional influence, but about managing it so that it doesn't distort perception or interfere with execution. Training the mind to process information objectively requires practice. It involves becoming mindful of emotional reactions, analyzing decisions after they are made, and looking for patterns that reveal hidden beliefs. Through this ongoing process, traders can reshape their mental environment to become more responsive to the actual conditions of the market rather than being controlled by past memories and outdated associations. Chapter 11: Why we need to learn how to adapt. Adaptation in trading is not an option, it's a requirement. Every moment in the market is unique. No two patterns, price movements, or conditions are exactly the same. Even if the setup looks identical to something you've seen before, the forces behind it, like participants' intentions, market context, or external factors, are never a perfect match. This creates a
It,
constant challenge. The
it's
market
such a
keeps changing, and your ability to succeed depends on your willingness to change with
and
it.
I ain't
Most people are not
involved.
taught how to adapt mentally or emotionally. In everyday life, routines are often enough to get by. But in trading, routines built on inflexible thinking can lead to losses. What works today might not work tomorrow. Holding on to fixed ideas, expectations, or past experiences causes traders to misinterpret or ignore the information unfolding in real time. This rigid mindset creates a gap between what the market is doing and how the trader reacts. The market does not reward stubbornness. It rewards those who can observe without judgment, make decisions based on current conditions, and take action can observe without. The market does not reward stubbornness. It rewards those who can observe without judgment, make decisions based on current conditions, and take action without hesitation. Learning how to adapt begins with recognizing that beliefs and internal programs from the past influence current behavior. If those beliefs are too rigid, they will resist new information. A trader might see signs that a trade is going against them, but still hold on, waiting for the market to prove them right. In doing so, they reject what is actually happening in favor of what they wish to be true. Adaptation requires mental flexibility. That means being able to shift your perception as new information appears. But shifting perception is difficult when deeply rooted beliefs get in the way. For example, if someone believes that being wrong is a form of failure, they may resist adjusting their position even when the market clearly suggests it. Instead of seeing being wrong as part of the process, they treat it as something personal. This reaction leads to denial, delay, or impulsive decisions, none of which are useful in a trading environment. To truly adapt, one must accept that the market environment operates differently from other structure environments. There are no rules about what must happen next. There are no guarantees, no fixed patterns that always repeat, and no authority figures to guide or protect you. The trader is entirely responsible for managing their mental and emotional responses. In this environment,
I'm about
information
to
can
leave.
flow freely, but meaning is
But
created
like
by
price is
choosing.
like,
How a
even though
trader
this
views
is demo,
trades and
like price is
information
not
depends on
even
their mental programming. Recognizing this internal
moving.
process
Like
is key to making meaningful change.
sad.
Instead of trying to control the market, a trader must work on controlling how they respond to the market. This requires awareness and effort. Awareness
Probably
helps a
trade next
trader
on
notice
Thursday
when they're
for
clinging to expectations or
not
ignoring
even
warning
try.
signs.
That's
Effort
when I
helps
can
them
trade
break
next at this
free
point.
from those patterns and respond to what the market is actually saying. It's important to understand that learning to adapt does not mean eliminating all structure or discipline. In fact, the more adaptable a trader becomes, the more important it is to have a structured framework in place to process new information. A good trading plan provides the foundation, but it should not become a cage. Adaptation happens within the boundaries of a clear plan, allowing for flexibility while maintaining control. Another part of adapting is learning from mistakes. Mistakes are not to be feared, they are valuable feedback. If a trade goes wrong, instead of blaming the market or bad luck, a successful trader examines what happened, identifies the misalignment, and makes changes. This process of review and improvement builds mental strength and prepares the trader for future challenges. Being adaptable also means letting go of the need to be right. Many traders fail because they place more importance on their ego than on staying aligned with the market. They want to prove something to themselves or others. But the market doesn't care about ego. It rewards those who are willing to stay humble, adjust quickly, and move on without emotional baggage. That mindset creates
That's
freedom,
having a
and
demo,
with
man.
freedom comes clearer decisions and greater
Market on
consistency.
BT
The
right now.
practice of adaptation becomes easier over time. As the trader builds experience, they learn to trust the process of letting go and adjusting. They no longer react emotionally to surprises. Instead, They anticipate change, embrace it, and respond with confidence.
If we
Adaptation
close
becomes a
above
natural
the
skill rather than a forced effort. In this state, the trader moves in sync with the market, not against it, and trading becomes less of a struggle and more of a flow. Chapter 12: The Dynamics of Goal Achievement. In trading, setting a goal is only the beginning. Achieving that goal requires a deeper understanding of how the mind interacts with external events. The structure of the mind is such that it contains both conscious and subconscious parts. The conscious mind can set a goal, but if the subconscious mind holds conflicting beliefs, it can stop a person from reaching that goal. This is especially true in trading where pressure, risk, and uncertainty can expose those hidden beliefs. The way the mind works is similar to how a computer processes information. It stores past experiences and forms beliefs based on those experiences. When new information comes in, the mind automatically compares it with past experiences. If the new experience seems similar to something from the past, the mind pulls up a stored belief and reacts accordingly. This reaction happens quickly and often without conscious thought. In trading, this process can lead to behaviors that go against a trader's intended plan. The goal achievement process starts with an idea or desire. This idea creates a mental image of success. For example, a trader might imagine making a consistent profit each week. That image alone can feel powerful. But unless the trader also has beliefs that support the goal, the image will remain just a wish. If the trader has internal doubts, fears of failure, or bad past experiences with
it's
money,
kind of fun than
those
other
internal
brands as well.
programs will resist the goal, even if the trader truly wants to succeed. Every goal has two key parts: the end result and the path to get there. The mind has to accept both. A trader might believe in the end goal of being successful, but may not believe that they are capable of handling losses or following a
At this
proven system.
point,
If this
I think the
happens,
trend has
the mind
shifted.
creates resistance. This resistance shows up
But
in many
we've bought
forms:
prices
procrastination,
past hour and
hesitation,
15 minutes. Like this
overtrading,
is
closing trades too
rubbish.
early, or even breaking rules that were set before the trade began.
Like, this is
To
just
move
rubbish.
forward,
But
a trader must learn how to recognize
like,
when
I'm
this
not
internal
stressing about it
resistance
today.
is present. That means being able to look at behavior
Go
honestly
on paper.
and identify patterns. It means asking questions like, why did I exit early? Or why did I break my rule this time?
But if we
These
looking to
questions
go
aren't
run out
about blame.
these Asia
They're
highs and
about
stuff,
bringing unconscious thoughts into the light so they can be changed. Change starts by
70
identifying the
point
limiting beliefs.
is not bad.
These are
So we
beliefs
have
that act
looks like
as
they want to go
invisible
up now. If we
barriers.
go up,
They might include
if you
ideas
could
like,
get all the
I
way up to
always
like
lose
45 months,
after a winning trade, or I can't trade under pressure. Once
not Asia
identified,
highs and
these
stuff,
beliefs can be replaced with new
and
ones. But this doesn't happen
probably
through
keep
logic
going up,
alone.
get all the
The
way up here.
subconscious doesn't change just because someone wants it to. It changes through experience, repetition, and emotional impact. This is why visualization and mental rehearsal are useful tools. When a trader mentally practices the steps toward the goal, the mind starts to accept the process as safe. The more the new path is rehearsed, the more it becomes familiar. And when something is familiar, it no longer feels like a threat. This reduces resistance and builds confidence. Goals must also be specific and realistic. Vague goals like, I want to be a successful trader, are hard for the mind to process. A better goal would be, I will follow my trading plan for the next 20 trades without breaking any rules. This kind of goal creates structure and a path. It gives the mind a clear image to follow. Reaching this kind of short-term goal reinforces the belief that success is possible. Over time, small achievements build a foundation for long-term success. The mind also responds to feedback. After each trade or trading session, reviewing what happened allows a trader to stay in touch with reality. This reflection should be done with honesty, not judgment. The goal is to understand what's working and what needs to be improved. With this process, new beliefs start to form and old patterns begin to fade. Another key idea is the role of focus. Whatever the mind focuses on will grow. If a trader is always focused on avoiding losses, the mind will constantly search for threats, which can lead to fear-based decisions. But if the focus is on following the plan, staying calm, and managing risk, then those actions will become stronger over time. Achieving goals also requires trust in the process, in the system, and in oneself. Trust cannot be forced. It must be built slowly, with every small step and every small success. Each moment of discipline is a building block that reinforces trust. When trust is strong, hesitation disappears. Decisions come faster and with more clarity. Over time, this turns into consistency. In the end, the mind must support the goal at every level. Chapter 13: Managing Mental Energy. In trading, the ability to manage your mental energy is just as important as managing your capital. Mental energy is the resource that powers your awareness, concentration, decision making, and overall effectiveness in the market. When your mind is focused and free of conflict, your decisions are quick, clear, and precise. But when your energy is scattered, trapped in emotional responses, or drained by internal conflict, you lose the capacity to function efficiently as a trader. Every decision you make and every thought you process consumes energy. This includes your conscious thoughts, but also your unconscious reactions, such as fear, doubt, frustration, or excitement. If you're carrying emotional baggage from a previous loss or anticipating future rewards with anxiety, you're allowing your mental energy to be diverted away from the present moment. And in the market, being fully present is essential. To manage this energy properly, you first need to become aware of where it goes. Many traders waste their energy reliving past mistakes or fantasizing about future wins. These thoughts may seem harmless, but they erode your focus and clarity. You're no longer observing the market objectively. You are filtering it through an emotional lens. The market becomes a stage for personal validation or redemption, rather than a neutral field where decisions are made based on probability. Mental energy should be concentrated on processing market information as it unfolds. If your focus is divided, if part of you is worried about being wrong or trying to recover from a loss, then your ability to act in your best interest is compromised. You might hesitate at the wrong time or force a trade that doesn't align with your plan. This is how traders sabotage themselves without realizing it. They're mentally tired, but mistake it for bad luck or a broken system. You can train yourself to conserve and direct your mental energy more effectively. This begins with self-observation. Pay attention to your thought patterns throughout the trading session. Notice when your mind wanders to non-essential ideas. Acknowledge distractions, emotional reactions, and impulsive thoughts, not to judge them, but to take back control. As you do this more often, you'll begin to see how much energy is wasted on things that do not serve your trading performance. Mental energy also flows in the direction of your dominant beliefs. If you believe you must always be right, then your energy will be spent protecting your ego. If you fear loss, your energy will go toward avoiding pain, not making smart decisions. In this state, every trade becomes emotionally charged. You are no longer trading to execute a plan, you're trading to protect yourself from discomfort. This leads to a cycle of overtrading, hesitation, or revenge trading. The solution is to align your beliefs with the reality of trading, where loss is a normal part of the process and perfection is impossible. Another way to manage mental energy is to limit the number of decisions you make during the day. Decision fatigue is real. Every time you analyze, adjust, doubt, or second guess, you are consuming energy. You can preserve mental resources by having a clear, predefined plan and following it with discipline. This structure reduces the number of unnecessary decisions and removes emotional noise from your trading process. Physical habits also play a role in energy management. A proper sleep routine, hydration, and regular breaks during your trading session help maintain clarity. But more importantly, you must create a mental environment that is clean, free from clutter, unresolved fears, and self-doubt. Keeping a trading journal helps in this process. When you write down your thoughts and emotional reactions, you release mental tension. This gives you more room to concentrate on the market itself. Visualization and pre-market routines can further anchor your focus. Before you begin your trading day, visualize yourself calmly executing your plan without being swayed by the outcome. This technique strengthens your mental control and channels your energy where it matters most. Finally, recognize that mental energy is not unlimited. It must be managed like a valuable asset. If you use it wisely, directing it toward observation, analysis, and disciplined execution, you will find yourself making better decisions with less effort. But if it is allowed to scatter across distractions and emotional conflicts, you will find yourself drained, confused, and inconsistent. Trading success doesn't come from working harder, but from thinking clearly. And to think clearly, your mind must be quiet, focused, and under control. Managing mental energy isn't a suggestion, it's a requirement. Chapter 14: Techniques for Affecting Change. To bring about real change in your trading performance, you must start by changing your mental structure. This includes your beliefs, your perceptions, and your emotional responses. These mental elements were formed through past experiences and often operate automatically. Since they were learned through experience, they can also be changed through new experiences. The key is to consciously design these experiences in a way that reshapes how your mind responds to trading situations. To begin this process, you need to become more aware of your internal responses to market activity. This involves paying close attention to how you think, feel, and act during every phase of a trade. By doing this, you can start to identify mental patterns that are no longer useful or productive. Once identified, these patterns can be replaced with ones that support consistent trading behavior. Visualization is one of the most effective tools for changing mental structure. By mentally rehearsing how you want to think and respond in specific market situations, you begin to create new mental pathways. This is not just about positive thinking. It is about mentally training yourself to behave differently when it really counts. You create a strong mental image of the trading behavior you want, then reinforce it with repetition. Over time, this new image becomes part of your natural response system. Another effective method is writing down your thoughts, beliefs, and reactions in a journal. This forces you to confront what you really think and feel about trading, especially in high pressure moments. When you see your thoughts written out, you can examine them more objectively. You begin to see the patterns and recognize where change is needed. This process also builds self awareness, which is essential for change. You must also be willing to experience discomfort. Creating change often brings up internal resistance. This is natural because your mind is designed to hold onto what it already knows. Even if a belief is harmful or limiting, the mind may resist letting it go simply because it is familiar. To move forward, you must push through this resistance and hold the vision of who you are becoming as a trader. Repetition is the tool that transforms a new idea into a belief. When you repeat a new behavior or response enough times, your mind begins to accept it as the new standard. This requires consistency. Sporadic effort will not rewire your thinking. You need to practice your new mental strategies daily, even outside of market hours. The more you practice, the stronger the new responses become, and the weaker the old ones get. Self talk is another technique that works well in shaping beliefs. The words you say to yourself have power. If you constantly repeat statements like, I always lose when I trade, your mind will treat that as truth and act accordingly. But if you consistently tell yourself, I follow my plan with discipline, your actions will begin to align with that belief. These affirmations must be spoken with certainty and belief to be effective. You are, in essence, training your subconscious to support your trading goals. It's also important to monitor how you define success and failure. If you define success as only winning trades, you will reinforce anxiety and fear. But if you redefine success as following your trading plan flawlessly, regardless of the outcome, you take back control. This shift allows you to stay focused on your process, not the result, which is critical in building emotional stability. You should create a mental structure that includes clarity, focus, and emotional neutrality. This is best achieved by setting daily intentions before you trade. These intentions may be related to patience, discipline, or managing risk. Writing them down and reviewing them before each session helps anchor your mindset. You begin to approach the market from a place of readiness rather than reactivity. Another way to promote change is through feedback. By reviewing your trades and reflecting on your decisions, you can identify moments where your mental framework either helped or hindered you. Honest feedback allows you to fine-tune your approach. You learn faster and avoid repeating the same mental mistakes. When you apply these techniques consistently, your mind starts to shift. You become less reactive, more focused, and better equipped to handle the challenges of trading. Change happens when you deliberately create new mental habits and reinforce them with practice. Every action you take in this direction brings you closer to becoming the trader you want to be. Ultimately, the goal is to reshape your internal environment so that it supports your external goals. This is not a one-time event. It is an ongoing process. Chapter 15: How to Become a Disciplined Trader. To become a disciplined trader, it is important to understand that discipline in trading is not about controlling the market or trying to predict it perfectly. It is about consistently controlling your own behavior in response to the market's movements. Discipline comes from learning how to think in probabilities and understanding that each trade is just one event in a series of many. There is no need to assign special meaning or emotional weight to any individual outcome. The focus should always be on following your plan without hesitation or fear. Discipline starts with having a clear trading plan. This plan must include specific rules for entering and exiting trades, risk limits, and position sizes. These rules must be followed exactly, without changing them during a trade. The purpose of this structure is to take away the need for decision making in the heat of the moment, where emotions can influence judgment. By following the plan, you make decisions based on logic and preparation, not on feelings or market noise. It is also important to accept that losses are a normal and necessary part of trading. Losses do not mean something is wrong with the strategy or with the trader. They are part of the statistical edge that plays out over time. A disciplined trader does not react emotionally to losses. Instead, they accept the loss, learn from it if needed, and move on to the next trade without hesitation. Trying to avoid losses or needing to be right all the time only leads to emotional pain and inconsistent actions. Risk management is a key element of becoming disciplined. Every trade must have a predefined amount of money that is acceptable to lose. This amount should be small enough that it does not cause stress or emotional reactions. Proper risk control makes it easier to stay calm, think clearly, and follow the plan without fear. When the risk is controlled, there is less pressure to be right and more freedom to allow the market to do what it will do. Another important step is to fully believe that trading is a game of probabilities. Each trade has an uncertain outcome, and anything can happen. This belief must become strong enough that it allows for full acceptance of any result. The outcome of one trade does not matter in the larger picture. What matters is executing consistently over a series of trades. Thinking in probabilities helps you avoid placing too much importance on individual trades, which often leads to emotional reactions and poor decisions. It is also necessary to trust yourself to execute the plan without second guessing. This trust is built by repeating the process over and over until it becomes natural. Consistency in following rules, reviewing your trades, and staying honest about your performance all help in building this self-trust. Discipline grows as the mind learns that following the plan leads to better long-term results than reacting emotionally to each trade. Recording trades in a journal helps reinforce discipline. Writing down why a trade was taken, how it was managed, and how it ended creates accountability. Reviewing the journal reveals patterns, both good and bad, and allows for improvement. This habit creates structure and supports consistent behavior. Practicing staying focused during trades is also helpful. Avoid distractions and stay engaged with the plan. If the plan says to exit, exit. If the plan says to wait, wait. Discipline is about doing what needs to be done, even if it feels uncomfortable in the moment. Over time, the discomfort fades and discipline becomes easier to maintain. To become a disciplined trader, you must be willing to change your habits. This requires repetition and mental training. Each time you follow your plan correctly, even when it's hard, you're training your mind to behave in a disciplined way. Over time, these small acts of discipline build a strong internal structure that can guide your actions through all market conditions. Discipline is not a gift, but a skill that can be learned and developed. It takes effort, awareness, and a strong desire to succeed the right way. There is no shortcut. Discipline is what allows traders to take advantage of opportunities without being controlled by fear or greed. It gives clarity in chaos and the ability to stay focused even when results don't come immediately. When discipline becomes a natural part of the trading process, decision making becomes clearer, stress is reduced, and performance improves. A disciplined trader does not chase trades, does not panic in losses, and does not get greedy in wins. The focus remains on process, on consistency, and on following a well-tested plan. In the end, discipline is the path to consistent success in trading, and it begins with the decision to commit to the process every single day. Chapter 16: The Steps to Success. To succeed in trading, there must be a complete and structured approach that integrates mental clarity, consistency, and responsibility. The first important step is learning how to think in probabilities. This means accepting that no single trade has to work, and success comes from the outcome of many trades over time. Traders must stop attaching their self-worth to any single result and begin to think like a casino. A casino does not care about the outcome of one game. It relies on the edge it holds over thousands of games. Similarly, a trader with a real edge must trust the statistical advantage rather than looking for perfection in every trade. It is also necessary to define a clear trading plan. A proper plan includes rules for entries, exits, risk per trade, stop-loss placement, and how to manage the trade while it's open. These rules remove confusion and reduce the chance of making emotional decisions during live trading. Following this plan consistently is what separates a disciplined trader from one who trades on impulse or hope. The key to staying committed is understanding that the trading plan is not a guarantee of immediate success, but a framework for building consistent habits. Record keeping becomes a major factor in personal growth. Every trade must be documented with entry point, exit point, risk taken, strategy used, and thoughts at the time of execution. Reviewing this journal helps identify patterns and behaviors that support or harm performance. Without this reflection, it's easy to repeat mistakes unconsciously. Over time, this habit helps to shape a clearer view of what works and what is not. It also helps in managing expectations, which is a crucial part of staying grounded. The role of self-responsibility cannot be overlooked. In trading, there is no one to blame for losses but oneself. Taking full responsibility for every action taken removes the mental burden of blame and excuses. This mindset also allows one to take constructive feedback from each outcome rather than being emotionally disturbed. Success in trading means developing trust in oneself to execute based on plan, not emotion. This inner trust grows with repeated action and observation, not from motivational thinking. A solid understanding of risk is also necessary. Risk must always be defined before a trade is placed. That means knowing exactly how much of your capital is being risked and being comfortable with losing that amount. If the potential loss feels uncomfortable, the position size is too large. Managing risk this way keeps the mind calm and prevents panic. Risk control is not just a money issue. It is a tool to protect your psychological capital, which is even more important. It's also important to focus on execution, not on the outcome. A good trade is not defined by whether it made money, but by whether it followed the plan. There will always be winning trades that were poorly executed and losing trades that were executed perfectly. Only when execution is done consistently can results become reliable. This mindset helps remove the emotional roller coaster many traders go through with each win and loss. Flexibility in thinking is another key part. The market is always changing, and sticking to a rigid mindset leads to losses. A successful trader stays open to new possibilities and adjusts the plan when the data shows it's necessary. But this change should be based on logic and observation, not emotion or fear. Adapting with clarity allows one to survive and grow in different market conditions. The practice of preparation is also stressed. Each trading session should begin with a review of market conditions, analysis of setups, and mental readiness. This habit improves confidence and reduces hesitation. When preparation becomes routine, trading becomes less stressful and more focused. This daily discipline builds momentum over time. Another important step is to build internal support. Traders often work alone and need to create a strong internal dialogue. This means replacing fear-based thoughts with focused ones and learning to self-correct without being self-critical. Over time, this leads to mental balance. Support can also come from connecting with other traders who are growth-minded, but the most lasting support comes from within. Finally, patience plays a central role. Trading success is a process, not a one-time event. Building skills, trust, and consistency takes time. Rushing the process or looking for shortcuts only leads to setbacks. Each experience in the market whether a gain or loss, is part of this learning curve. With each repetition, new habits are formed and old emotional patterns are replaced. This commitment to the process brings lasting growth and result. Chapter 17, Final Note. As you move toward becoming a consistent and successful trader, it's important to understand that the real work lies in changing the way you think. The journey is not about beating the market, outsmarting others, or even finding the perfect trading system. It is about learning to trust in your ability to make decisions, to follow through with discipline, and to respond to the market without hesitation or fear. It requires developing a state of mind where you can stay calm and objective, no matter what is happening around you. Trading presents a unique challenge because it requires doing things that go against common human behavior. Most people are trained from an early age to seek certainty and avoid pain. They are taught to be right, to protect their self-image, and to avoid failure. But the market does not reward those habits. The market operates on uncertainty, on the edge between profit and loss. Success comes not from trying to control it, but from learning to manage yourself within it. The key lies in recognizing that every trade is a probability. Each outcome is independent, and it is not connected to what happened before or what may happen next. It's a mental game, and the one who plays it well is the one who no longer allows past outcomes to affect present decisions. That kind of thinking takes effort because the human brain naturally wants to avoid pain and repeat pleasure. But if you allow past losses to bring fear or past wins to create overconfidence, then you're no longer thinking in probabilities. You're reacting emotionally. The disciplined trader has trained their mind to accept the risk fully before entering a trade. Once the risk is accepted, they no longer need to worry about the outcome. Whether it results in a profit or a loss, they have already accounted for it. This mindset creates the space to think clearly, to act without hesitation, and to avoid the emotional roller coaster that most traders experience. Developing this mindset doesn't happen overnight. It comes from consistent self-observation, learning from mistakes, and making small adjustments every day. It also requires being honest with yourself. You have to recognize the patterns that lead to impulsive decisions or the need to be right. You need to look at how often fear or greed enter your process, and then train yourself to remove those influences. That is the real work. It's also important to understand that there will always be losing trades. No matter how advanced your strategy is or how long you've been trading, losses are a natural part of the process. Trying to avoid them will only lead to frustration. Instead, the focus should be on how well you executed your plan. Did you follow your rules? Did you enter and exit based on your strategy, not your emotions? These are the real measures of progress. In the long run, the outcome of any single trade does not matter. What matters is your ability to stick to your process and maintain a consistent mindset. Over time, this leads to steady growth and long-term profitability. There is no need to chase big wins or avoid small losses. The goal is consistency, doing the same right things over and over, regardless of how the market behaves. Everything you need to succeed is already within you. The tools, the mindset, and the structure can all be developed with time and commitment. There's nothing outside of you that you need to control because the market is not something you can ever control. What you can control is your response to it. That's where true power lies. As you move forward, stay focused on the process. Build routines that support your discipline. Reflect after each trading session. Keep notes. Watch your thoughts. Practice patience. And most importantly, commit to growth not just as a trader, but as a decision maker. Every step you take toward mastering yourself is a step toward mastering the market. This work is ongoing. Even when you begin to see consistent profits, the work doesn't stop. The market changes, your life circumstances change, and your mind will continue to evolve. Staying committed to the mental side of trading ensures that no matter what the market does, you remain in control of your actions. Let this be your reminder that the real edge in trading is not your method, your tools, or even your experience. The real edge is you, your mindset, your discipline, and your ability to respond with clarity and control. That is what creates lasting success. Hello, everyone. What if the biggest threat to your trading success isn't the market at all? What if it's you? Behind every chart pattern and price move, there's a hidden battle taking place inside the minds of traders. fear, greed, panic, euphoria. In the psychology of trading, Dr. Brett Steenbarger dives deep into the emotional and psychological forces that silently make or break fortunes. This isn't just another trading book. It's a raw exploration of real traders facing real demons, with life-changing insights that could transform how you think, feel, and trade forever. Get ready to uncover the truth most traders ignore, their own mind. Before we dive deep, don't forget to like, share, and subscribe for regular content on trading psychology, success habits, and untold stories behind the charts. Let's begin with Chapter 1, The Woman Who Could Not Love. She was a successful trader on the outside, disciplined, intelligent, and logical. Her track record was solid, and she followed her trading system with great precision. Yet, something was missing. There was a coldness in her behavior, a distance she maintained from her trades and the people around her. She treated losses and gains the same, showing no signs of being emotionally connected to her performance. Her trading wasn't failing, but it wasn't growing either. There was no evolution in her style, no innovation, no fire. It was as if she had built a wall between herself and the market. In sessions, it became clear she didn't trust emotions. She believed they were distractions, unreliable and dangerous. She worked hard to keep feelings out of her decisions. This mindset had roots far beyond trading. It reached into her personal life, where she struggled with intimacy and connection. She avoided relationships, kept people at a distance, and maintained a sense of control by being emotionally detached. This same mindset had carried into her trading. Her trades followed a rigid process. She relied on numbers, patterns, and checklists. She had trained herself to avoid excitement, fear, or disappointment. But this detachment came at a cost. She wasn't responsive to changing market conditions. She stayed locked into setups, even when new information suggested otherwise. When asked about how she felt during trades, she often said she felt nothing. This wasn't calmness. It was a form of emotional numbness. As the work continued, her trading history revealed a pattern. She often missed opportunities where a little intuition or risk-taking might have led to significant gains. She exited positions too early, unwilling to hold through uncertainty. She avoided trades that felt too aggressive, even when analysis pointed in favor. Her system was built to keep emotions out, but it also kept growth out. She wasn't making mistakes in a traditional sense. She was limiting her potential by keeping everything safe, exploring deeper. It became clear her early life had shaped this approach. She had grown up in a household where vulnerability was unsafe. Expressing feelings brought punishment, not support. Over time, she learned to suppress emotion as a survival tool. This suppression became part of her identity. In her mind, to feel was to lose control. To love was to invite pain. Trading became a perfect arena to express this worldview, structured, controlled, and emotionally neutral. But markets are dynamic. They breathe, shift, and evolve. The best traders adapt, sense, and feel subtle changes. They use emotion not as a guide, but as a signal. Fear alerts them to risk. Excitement shows opportunity. The goal isn't to remove emotion, but to understand it. Her trading needed this flexibility. She needed to reconnect, not just with emotion, but with the part of herself that had been shut off long ago. To begin this process, her sessions introduced small exercises. Instead of avoiding feelings, she was asked to notice them. She kept a log, not just of trades, but of emotional responses during the day. What did she feel when entering a position? What did she feel when holding? What emotions arose when she exited too early? The goal wasn't to fix these emotions, but to acknowledge them. She also began journaling outside of trading. Each morning, she wrote freely about anything that came to mind. No editing, no rules. Over time, these journals revealed patterns, recurring doubts, old fears, and suppressed desires. Slowly, she began to understand how her emotional detachment wasn't strength, it was armor. In time, her trading started to shift. She became more curious. She allowed herself to explore trades outside her rigid setup. She stayed in positions longer, learning to trust her process and tolerate uncertainty. She began reviewing not just what went right or wrong in trades, but what she had felt during them. This added dimension gave her new insight. Emotion wasn't the enemy, it was information. She even allowed herself to take breaks from trading, not out of fear, but out of awareness. She started building relationships, both in her personal life and within trading communities. She sought feedback, shared ideas, and opened up about struggles. This willingness to connect mirrored her growth as a trader. Eventually, her performance improved, not dramatically, but steadily. She didn't just gain more profits, she gained more perspective. She stopped seeing the market as something to control and began experiencing it as something to engage with. Her trading became a reflection of a deeper truth. Chapter 2: The Student Who Wouldn't Study. He came into the office with confidence in his eyes and a good trading record behind him. But as the sessions began, something odd became clear. He wasn't growing. Despite his potential, his development was stuck. He wasn't reading trading journals. He wasn't backtesting new setups. He wasn't reviewing charts before market open or journaling trades after market close. His trades were impulsive. He entered positions without clearly defined rules or preparation. The strategy he once followed with discipline had turned into instinctive action, guided more by feeling than by planning. As questions dug deeper, it became clear that his reluctance to study wasn't laziness. It was something older, more rooted. In school, he always managed to get by on natural ability. He never needed to study for exams, and when he did, the results didn't always improve. Over time, he developed a belief: studying doesn't pay off. It only wastes time. That belief now followed him into trading, even if he didn't see it. His trades were not supported by consistent analysis, and he rarely looked back at what went wrong. Without this feedback loop, he was running blind. To understand and change this pattern, the first step was awareness. He began by keeping a detailed journal, not just of trades, but of thoughts before, during, and after trades. He wrote about the logic for each entry, what indicators he used, what patterns he saw, and why he exited when he did. It was uncomfortable at first. He didn't like confronting his thought process, especially when it was unclear or rushed. But slowly, the act of writing forced him to think. It slowed him down, made him ask himself hard questions. Why did I take that trade? What was my edge? What went wrong? Did I follow my plan? After 2 weeks of journaling, patterns started to emerge. Many trades had no setup. Some were revenge trades, others were chasing. Entries came from fear of missing out. Exits came from panic. The data didn't lie. He saw the gap between what he believed he was doing and what he was actually doing. That realization gave him control. With control came the ability to change. He began setting specific goals for each week. Not goals like make this much money, but process goals. Review charts for 30 minutes daily, study one historical setup per night, summarize each day's market behavior in a sentence. He made it measurable. He turned study into routine. Once the habit formed, he saw progress. His trades became more selective. Entries were backed by analysis. Stops were planned in advance. Losses still happened, but they no longer triggered spirals of emotion. Wins came from structure, not luck. To reinforce the behavior, he added a layer of accountability. He sent weekly performance reviews to a mentor. Each review had a scorecard, rating him on trade planning, risk management, emotional control, and post-trade review. The scores weren't about punishment. They were feedback, a mirror showing him where he was sharp and where he was slipping. Over time, the numbers improved. He felt more in control, not just of trades, but of his process. At one point, the market turned volatile. Others panicked, but he stuck to his plan. He had studied the behavior of the market in past volatility. He knew what setups tended to work. He narrowed his focus and increased position size only when the edge was clear. The preparation gave him confidence. The trades came from clarity, not impulse. As months passed, studying wasn't a task anymore. It was part of the process, like brushing teeth. He reviewed the market every morning. He kept detailed records of each trade. He held himself accountable not just on results, but on execution. His growth didn't come from trading harder, it came from trading smarter. The transformation wasn't dramatic. It didn't happen in a day, but step by step, he shifted from an intuitive trader to a disciplined one. He built a foundation of knowledge that could support his decisions in all kinds of markets. When a trade failed, he knew why. When it worked, he could replicate it. He learned that natural talent wasn't enough. In trading, talent fades without structure. Success depends not on what you feel, but on what you know what you prepare, and how you respond. And all of that begins with the decision to study, not for school, not for show, but for the craft itself. Chapter 3: The Woolworth Man. He was known simply as the Woolworth Man, an older trader, calm in his demeanor and not particularly flashy. His style of trading had a sense of rhythm and consistency. He came from a time before trading platforms became high-speed machines. His background wasn't rooted in computers or coding, but in retail. Years spent behind the counter at a Woolworth store had trained him in observing people, reading moods, and understanding the psychology of behavior. That observational skill, which once helped him understand what customers wanted to buy, now helped him read the market. He didn't use charts filled with indicators. He didn't rely on elaborate models. Instead, he watched price movement with focus, almost like how he once watched customers scan the store shelves. He was drawn to patterns in price action, particularly to what traders now call market structure, how prices react around support and resistance. His mind naturally logged repetitive behavior. He didn't need elaborate systems because his edge came from observing how others acted when fear or greed pushed them too far. His trades were not frequent. He waited until a pattern repeated itself enough times that he could trust it. He would then enter his position calmly, always with a fixed stop, always with a clear target. He sized his trades modestly. He didn't chase profits, and he didn't panic over losses. Over time, his results were steady, never explosive, but always growing. His strength was consistency, not complexity. He mentored a younger trader who approached the market differently. This new trader had a strong academic background. He built models, tested systems, and focused on statistical probabilities. His monitors were filled with data feeds, price projections, and scripts. He believed in algorithms. He often looked at the older trader's methods and dismissed them as outdated. The older man didn't even know how to use half the tools available today. Yet month after month, the Woolworth man would end in profit, while the younger one often broke even or worse. Eventually, curiosity led the younger trader to ask questions. He wanted to understand what made the older man succeed with such simple tools. That's when he learned that trading wasn't only about tools, it was about pattern recognition, discipline, and emotional steadiness. The Woolworth man didn't care what caused the move. He cared how people responded to the move. When prices moved too far too fast, he looked for exhaustion. When they stalled near key levels, he looked for signs of accumulation or distribution. He didn't trade headlines. He ignored earnings.